Well, good morning. Yes, it's me, Kashkari, coming to you live from Madison, Wisconsin. It is absolutely gorgeous here. This is Lake Monona, I think is how you pronounce it, right behind me, and it is just beautiful. The sun is out. It's about 65 or 70 degrees. It is going to be absolutely gorgeous. Today is May 8th, Wednesday, May 8th, and here are the things that you need to know to get your day started. So what happened yesterday, right? The big thing was Kashkari. But we'll talk about that in a minute. Stocks churned yesterday, right, as they digest the most recent moves. And then Kashkari, Minneapolis Fed president, he did come out, but he's leaning a little bit hawkish. He doesn't seem to understand the robustness of the economy. Bonds continued to rally, and that sent yields down just a little bit, nothing dramatic. The dollar index is up, oil fell, and gold just kind of churning in space. And what do we have for dinner tonight? Well, this is really if you're stuck. We're having the brand muffins, and it's for breakfast because that really helps you get unstuck. But that's a whole nother story. We'll get to that in a moment. So look, yesterday stocks churned, right? As the participants digest the latest move up and await more economic data. At the closing bell, we saw the Dow was up 32 points, the S&P was up 7, the NASDAQ was down 17, the Russell was up 4, the transports gained 54 points, and the equal-weighted S&P was up 19 points. So, like I said, Minneapolis Fed President Kashkari came out. And what did he tell us? Well, he said, and I quote, "It's hard to explain the robustness of the economic activity," which in my mind is in itself a problem if he doesn't understand why. All the spending and free money, but let's not go there. He went on to say that the most likely scenario is for the Fed to hold rates where they are and then sit here for an extended period of time. If disinflation starts to come again, or inflation starts to back down, or we see a marked weakening in the labor market, then that might lead us to cut back on interest rates. But until that happens, it ain't happening, right? And so there you have it. Sounds to me like he is supporting the commentary from his colleagues on Monday, which leaned a little bit more cautious, as well as the commentary made by Jay Powell last week at the FOMC meeting, who, in my opinion, was very clear on the direction of rates and where they are going or not going anytime soon. Anyway, how can they if the data just doesn't support it, right? Is one NFP report suddenly going to be the driver? Is that going to define the trend, this one NFP report on what the Fed's going to do? I don't think so. Now, while there were not any fireworks to speak of yesterday in the markets, there were no implosions, there was one single one, and that was Disney. Fell by 9.5% on the back of some very disappointing earnings news, as well as some poor forward guidance, right? Neely's comments did nothing to cause the algos to go into panic mode yet. The latest rally that has powered stocks higher recently appears to be struggling just a bit. But remember what I told you yesterday. I'm not surprised, nor should you be. Understand that while the move up Friday and Monday, the strong rally, was impressive, it happened on below average trading volumes, right? Which is not so impressive, Kashkari. When you have an advance like this, but you don't have the supporting volume, it's hard. It tends to question the sustainability of such an advance. And so therefore, that's something you have to really concern yourself with. And that's what I think is happening. I think traders and algos once again got ahead of themselves, right? Recreating that multiple rate cut narrative on the back of this one data point, because they continue to stamp their feet. They continue to suggest that 5.25% rates are usurious. Now, usurious suggests that someone is charging illegal or exorbitant rates of interest for the use of money. I'd say that Fed funds at 5.25% or mortgages at 7% are far from usurious, right? But revolving credit cards at 30+%, they may be considered usurious, but that's a whole other story. We can talk about that at another time. Now, the recent rally in stocks that has us kissing all-time highs, even with rates at 5.25%, which some people are calling too restrictive, does have to consolidate just a bit. Some valuations are stretched in some parts of the market, which is why I say you need to be strategic. Strategists around the street remain conflicted. At J.P. Morgan, they're sending a message of more caution, while strategists at Bank of America, Citibank, and Goldman Sachs are suggesting this is not the time to back off. Jump in, the water's fine, right? I'd say I tend to lean a little bit more cautious. Not out, just cautious. Now, recall that on Monday, traders and algos pushed the S&P up through trendline resistance at 51.31 to end the day at 51.80, leaving me to tell you that technically this was a bullish signal. But we needed to see the follow through, and we needed to see the accompanying volume in order to believe that the move is real. Barring that, I would not be surprised at all to see us fizzle out just a bit and retreat as stocks churn, awaiting more, and investors are awaiting more economic data that will offer clues into the health of the economy and the future of monetary policy. Look, stocks can go higher if the fundamental conditions and future guidance remain strong, even with rates right here. But if the conditions change, then the outlook changes. And then yes, the analysis must change. But right now, the conditions don't really appear to be changing. Economic activity is strong. The labor market remains strong, right? Despite what some will say to the contrary, all while inflation remains sticky. And that's kind of the thorn in the side of the Fed. And we're going to get another look at the latest inflation reads, the April inflation data next Tuesday and next Wednesday, when we get the PPI and the CPI, right? The producer price index and the consumer price index. Now, the jury's still out on what they're going to reveal. But here are the estimates. And right now, these are only estimates. The top line month-over-month PPI is expected to rise by 0.3%, which is above last month's 0.2% rise. The year-over-year estimate's expected to be up 2.1%, in line with last month. Now, PPI ex food and energy is expected to be up 0.2%, while year-over-year is expected to be up 2.3%. Top line CPI, which is the consumer price index, month over month, expected to be up 0.3 versus last month's up 0.4, while the year over year is expected to be up 3.4% versus last month 3.6. Now, ex food and energy, month over month up 0.3, while the year over year is up 3.6%. So there's a lot riding on this. If we get these numbers, then I would expect that the rally and the rate cut narrative is going to continue. But if the numbers are stronger, then I would expect that the market to back off a bit, because it would not support the rate cut narrative, right? Now, just to be clear, I am in the camp that no matter what these reports reveal, I still do not think that the Fed is cutting rates anytime prior to the election. Not in June, not in July, not in September. If they're going to cut now, it's going to have to be in November or December. And that's still a stretch as far as I'm concerned, unless the economy suddenly goes off the rails and into a tailspin. And if it does, then we're going to be talking about full percentage point cuts and not 25 basis point cuts, right? ̌ķīcī? Now, bonds continue to move up. The TLT gained 0.6, the TLH gained 0.5%. That sent yields down just a bit. The 10 years now yielding 4.46%. The 2 years yielding 4.83%. So those are down significantly from where they were even a week and a half ago. The dollar index, the DXY, has been rising over the past couple of sessions, bouncing off support at 104.63 to end the day at 105.50. And that suggests that rates are not going anywhere. Holding rates here will support the dollar. And a stronger dollar is going to put pressure on commodity prices. And speaking of commodities, oil. They fell again yesterday, right? So you think the stronger dollar is one reason. Now pierced the long-term trend line support at 77.88 to trade as low as 76.89. The American Petroleum Institute reports that the U.S. crude and fuel stockpiles rose last week, suggesting weakening demand. I'm not buying it, but that's what they're telling you. The Energy Information Administration is expected to report their findings today, and they are expected to report a decrease in crude inventories. That's opposite. Ongoing hopes of a ceasefire in Gaza has been putting pressure as well on oil, right? As of this morning, the ceasefire has not happened, and in fact, the Israelis continue to make targeted strikes on the Rafah crossing. The recent decline in oil only makes the Saudis more committed to extending production cuts into the third quarter as they aim to keep the market tight to support prices against the non-OPEC suppliers, think the U.S. Given that we have broken support, you have to consider now the possibility of a move down into the mid-70s for oil before it finds new support. Gold, on the other hand, did not do much. It continues to hold steady right here at 23.25-ish, right, as it awaits a Gaza resolution. Gold remains in the 2,300, 2,400 trading range. Nothing dramatic there. U.S. futures this morning are mixed. The Dow futures up 17. The S&Ps are down 2. The NASDAQ is down 10. The Russell is down 10. With the lack of any real economic activity or data that's due out the rest of this week and the earnings season winding down, do not look for anything specifically to drive the action. I think it just churns, digesting the recent move up. I do not think that we push much higher, but nor do I think that we go substantially lower. I think we're just going to continue to churn right in here until we get next week's inflation data. European markets this morning are up by about 0.5%. Sweden, the central bank there, cut interest rates by 25 basis points for the first time in 8 years, leaving their rate now at 3.75%, right? They also suggested that 2 more cuts are possible if inflation continues to ease. Other factors driving the action of the ongoing earnings reports across the European zone, nothing more than that. The S&P closed at 51.87, up 7 points yesterday. Recall that the next target is 52.62, which is the all-time high, right? So it appears that we're in this 51.31, 52.62 trading range. And while it may take a while to get there, I'm not sure that it's happening today or anytime soon. Remember, the action has been on weak volumes, and that speaks to sustainability, which is why I continue to advocate for the plan. Create one, build one, talk to your advisor, and then stick to it. You feel free to call me to discuss at any time, because I'm always happy to talk about creating plans and then helping you understand markets and market action and long-term generational wealth investing. Okay, so like I said, we're having the brand muffin cycle. I think the market feels stuck. And if the market feels stuck, some people feel stuck, right? This is the classic Kellogg's recipe. You can get it on the side of the box. And right now, because the market feels a bit stuck, I thought it would be an interesting idea. You want to try the warm brand muffins when they come out of the oven with butter and a large glass of milk. Oh my God, reminds me of being a kid. Now, for this, you need 1.5 cups of flour, 2 teaspoons of baking powder, 1/4 cup of sugar, 1/4 teaspoon of salt, 2 cups of Kellogg's All Brand, 1 1/4 cup of whole milk, 1 beaten egg, 1/4 cup of vegetable oil, raisins if you want. You can also put bananas and walnuts in there too, but I'm just leaving it plain. You're going to preheat the oven to 400 degrees. You're going to combine all the dry ingredients and then set them aside. Now you're going to add milk to the bran cereal and then let it sit there for a couple of minutes so that the cereal gets soft. Then you're going to add the egg and then the oil and kind of mix it, right? Then take all of that, put it in a mixer. Then you're gonna add this, put the cereal into the mixer, and then slowly add the dry ingredients as you turn the mixer on. And it's just mixing it well, right? Mix it until it's all nice and combined. And then you're going to use a tablespoon. You're going to take out your muffin pans. You're going to spray the muffin pans with Pam or whatever you're going to put in there. Take a tablespoon and then fill the muffin pans with the bran cereal, with the bran mixture, right? Stick it in the oven. You're going to bake these for 20 minutes. 20 minutes or so, not much more. You don't want them to be dry. You want to leave them a little bit moist, right? Take them out and serve them immediately with butter and a large glass of iced milk. Oh my God, they are perfect that way. Look, in any event, it has gotten even more spectacular here in Madison. Look at the sky behind me. It's just beautiful. Maybe that speaks to how the market's going to react today. In any event, until tomorrow, take good care.